Greetings, everyone. This is Antonio Sigwich, your Chief Encouragement Officer. This is going to be our final installment on credit repair. What we're going to do now is analyze the way interest compounds on a credit card using a little known rule referred to as the banker's rule. Okay, so let's get into this. The official name for the banker's rule is the rule of 72. And here's what it states. You take whatever interest rate you're getting on your money, doesn't matter what it is, and you you divide the interest rate by the number 72. The answer is going to tell you how many years it's going to take for that money to double at that interest rate. This zero represents today. The $3,000 represents the credit card balance. The interest rate on the credit card is 18%. If we take 18%, divide 72 by 18%, it gives us 4. So a $3,000 credit card balance at an 18% interest rate, that balance will double in 4 years according to the rule of 72. So if it doubles in 4 years, that means that $3,000 in 4 years is actually a $6,000 balance. So let's move to the next part. Hopefully we got this part down. You can check all of this with your calculator, pause it, rewind it, do whatever you need to do. Now let's look at the next portion of this, okay? Let's move over here. Credit card companies require a minimum payment. Sometimes it'll say 3% or $25, whichever is greater, okay? So 3% of $3,000 is $90. The monthly payment, minimum monthly payment, is $90 per month. Well, let's back that out just a bit. $90 a month times 12 months equals $1,080. That is the total of 1 year's worth of payments on a $3,000 credit card balance at 18% interest. $1,080. Now, remember, in 4 years, that $3,000 doubles to $6,000. So let's look at what 4 years of minimum monthly payments looks like. $90 times 12 is $1,080. That's a year's worth of payments. $1,080 times 4, or times 4 years, is $4,320. Remember, this is a $3,000 credit card balance, making minimum payments over 4 years. We have made $4,320 in minimum payments on a $3,000 balance. Why? Because it's doubled, because we weren't able to pay it off within 4 years. So now we know what 4 years of payments looks like. $4,320. Well, let's do a quick recap. We've got an original balance of $3,000. It doubles, according to the rule of 72, in 4 years at 18%. That gives us a total balance of $6,000. If we make 4 years of payments, we know that's $4,320. We have a balance remaining of $1,680 after 4 years of payments. So in summary, this is crazy, y'all. A $3,000 balance will wind up causing us to spend $4,320 in minimum payments to pay off the $3,000 balance. And at the end of the 4 years, we will still owe $1,680. This banker's rule was actually designed to benefit the party that could leverage the interest. And the most commonly used entity that leverages this rule is credit card companies. Now, there's a way that you can flip the script and create leverage for yourself, but it will never be with a credit card, making minimum payments. There is another way, and we'll talk about it on the next video. But I really just wanted you to be able to see the way this whole picture looks, because this is what happens with credit cards. And this is why people are never able to break the cycle of debt. When the Bible talks about the borrower being enslaved to the lender, this is what it's talking about. When you're spending over $1,000 more in payments than the amount that you actually originally borrowed, that's a huge, huge challenge. But this is what our credit system is built on. Now, in the next video, we're going to take the rule of 72 and create leverage with it. See you on the next video. God bless. Don't forget to like, comment, and subscribe to this channel, and share this with someone that is just establishing their credit so that they can learn this up front and create leverage for themselves. We're going to talk about what we need to do in the very next video.